So I think we can start. We have a couple of participants. Co-host, you can please and admit the people as and when they enter. Am I audible? Yeah. Okay, so I'll just start. So a very good evening to one and all. I, Pratham Bharat, the chairperson for Commercium 2021-2022, would like to welcome you all for our event Cryptocurrency 101 Decoding the Hype with Mr. Vikrant Mehra. Before we start our insightful event, I would like to take a few moments to commemorate the Foundation Day of Commercium, the Commerce Society. With our sincerest gratitude to our principal, Dr. Rajendra Shinde, and our faculty founder, Dr. Suveba Pirani ma'am, I would like to congratulate each and every person associated to us in some way or the other. Right back in 2019, with our first logo designed on paper and starting out with a bunch of only 6 people, Commercium was founded. And from that day onwards, there was no looking back. We have witnessed exponential growth during these years under the able leadership of our student founder and chairperson Vedant Shukla. And the baton was then passed on to Anand Acharya, who only made things better and better. Following their footsteps, I hope to continue the successful run of our society in bringing young minds face to face with the real world and have valuable contributions in enhancing their knowledge and understanding. Now, owing to the pandemic, we have been left with no other way than to celebrate our Foundation Day online for the second time in a row. Despite that, our performance and success over the last 2 years have exceeded expectations. Every single member from top to bottom in the society has directly contributed to its success and has become a goodwill ambassador for commercial. Numerous challenges were faced, but we have all conquered them together and will continue to do so with the same spirit and enthusiasm. A heartfelt gratitude to each and every member of Commercium. Being a part of Commercium since the founding year and seeing the society so closely, I am sure our efforts in the past 2 years would have made our HOD Dr. Suveba Pirani ma'am and St. Xavier's College proud because one common unifying thread that runs through everything we have done, ever done at Commercium, is a spirit of care and empathy. And thus, without further delay, let us initiate our Foundation Day event, and who better than our esteemed speaker, Mr. Vikrant Mehra, to guide us through it. We welcome you, sir, and thank you for accepting our invitation. We will now have Samar, who will brief us about the speaker and will also set out a few instructions for the peaceful conduct of the event. Hope you all have an interesting experience. Over to you, Samar.
Thank you, Pratham. A very good evening to everyone. Our speaker for today's session is Mr. Vikrant Mehra, the Digital Marketing Executive at Zebpay. He has had valuable experience in the crypto space and is dedicated in educating individuals about the cryptocurrency market. He has some very interesting and relevant topics planned for our audience today. Before we start the session, a few instructions to maintain the decorum of the event and ensure its smooth happening. Participants are requested to please keep their microphones off, and if facing bandwidth issues, even the videos switched off during the session unless they are instructed to do so otherwise. The questions can be asked via the link provided in the chat box, and they will be answered as and when Sir deems suitable. Do not forget to upvote or like the questions which you want to be answered by the speaker. In case of any technical queries, feel free to drop us a personal message in the Zoom chat. Lastly, please maintain discipline throughout the event to ensure an enriching experience for all of the participants. I'll now hand over the session to Mr. Vikrant.
So thank you, Samarth, and thank you, Pratham, for having me. It's been an absolute pleasure to come back to Xavier's, and I think getting to speak about crypto is something that I enjoy personally because I think, number one, not only is it my day job, but working with and sort of speaking to people who are first-time investors, both with where I work, both with people where I don't necessarily work, allows me to get a better understanding of what are the actual questions that people want to know and want to learn about before they feel confident or comfortable making that first investment. And I think it gives me a good sense of exposure because when you're working in the space day in and day out, 9 to 5 every day, it can very easily be that you lose yourself and lose perspective of what's happening at the surface level entry point as such. So I think one quick question that I sort of hope to answer by the waterfall method. So Samarth, if you could just sort of repost the link once this happens. if everyone on the chat right now could put in the chat how comfortable or how familiar you are with the ideas of Bitcoin, blockchain, crypto. Answer with a scale from 0 to 10 or 1 to 10. 10 being super confident you've already been investing. 0 is that this is the first time you've heard about these words. So if you could put in the overall chat what your number would be, and we'll take like 2 minutes just so that I have a better understanding of where we're at. All right, you can put in and start entering your numbers now. Okay, so I think we have a fair amount of zeros and ones here that I can see. A couple of twos, 1 9. Okay, nice, Himanshu. Very interesting. Lots of zeros, 1 5, 1 0.5. Interesting. So I think on the whole, we're leaning towards, let's say, we're familiar, we know what the words are, we've heard of the terms, but not too many people have actually made an investment yet or started buying their first crypto. And that's great, right? Because it works out perfectly for me. And it also helps us now establish one absolute baseline for how we go about this session. So, okay, awesome. So thank you for sharing the screen. What we're going to do first is, in fact, before we even get to Bitcoin, we're going to take a step back and talk about the idea of money, or even the story of money, and how that sort of concept has evolved across the entire spectrum of humanity. So Samarth, if you could just go to the next slide, please. So let's stay here for a second. What is the absolute function of money? It is, I'm sure, as the econ students in the room will be able to tell me, that it facilitates an exchange of value, right? And way back in prehistory, we've had various examples of direct barter being used. But the problem there immediately becomes evident in as much as someone who wants to buy wheat and only has, let's say, milk to offer will not be able to sort of exchange that unless there is someone willing to buy his milk. We needed a common medium of exchange, and we immediately found what I'm going to call proto money in this concept. A lot of people use cowrie shells. A lot of people began with gold coins. The Roman Empire used to pay its soldiers in salt because that's how valuable it was. But each and every one of these commodities that were used as a medium of exchange had their own inherent value. The reason they were accepted was because they were valued in and of themselves. This idea, as society progressed and moved towards what is now we know as fiat money, sort of eroded. Instead, we now have a central authority that issues almost a promise to every citizen of every different country that the paper note that we use as currency today holds a certain amount of value. And that's what you see when you see that little bit of a signature that the governor of the RBI has on every single Indian note, that a 500 rupee note is worth exactly 500 rupees. It's not any random piece of paper that is inherently that valuable. It is the value of the promise, the inherent trust that we have that the system works. Now, here comes the problem. What happens if this central authority doesn't act in the interest of everyone? We've seen several incidents of something like this happening, right? With Venezuela, for example, the government is so unstable that people would prefer to use an alternative rather than the national currency because it's more stable than a currency or a coin that is so volatile. Alternatively, in our own country, we had, let's say, demonetization happen about 7 years ago, when overnight, quite literally, we had what was very universally considered a 500 rupee note deemed valueless, simply because a central authority or a central body deemed it that it would be so. I'm sure they had their reasoning, and I'm sure there was a fairly large discussion that sort of preceded that decision. But at the end of the day, the decision maker only had to convince, let's say, a board of advisors, let's say what, 12, 15, maximum 20 people. how about trying to convince all of the country of India that demonetization was a good idea, irrespective of whether or not you had black money hidden away, irrespective of whether or not you were a cash heavy business. If you use the money that the government promises you, you should have a say in how it's regulated. We do technically, in as much as we vote for the people that make these policies, but the Bitcoin promise makes that kind of involvement far more direct. So the Bitcoin promise, as I'm going to elaborate here, essentially takes the power that is concentrated in a body like the RBI, or in the US's case, let's say the Federal Reserve, and distributes it amongst the people who actually use that money on a day-to-day basis. How does that happen? That is where, and this is, I'm going to sort of take a quick pause to explain the differences between Bitcoin, between blockchain, and between cryptocurrency as a whole. Blockchain is the underlying technology on which all cryptocurrencies run. Bitcoin is the first cryptocurrency that was ever minted, conceptualized, etc. And that is what led to the idea of blockchain becoming mainstream. Bitcoin and other coins, Ethereum, BAT, Litecoin, Monero, Dogecoin, are all cryptocurrencies put together. So just a little bit of a housekeeping note here. One thing that I will make clear in the beginning is that I will very often refer to Bitcoin and immediately clarify when I'm talking about specifically Bitcoin, or if I'm talking about Bitcoin as a general cryptocurrency. The idea here is that you are now sort of taking the power of a central authority and bringing it out to the people who use it. How does this happen? Next slide, Samarth, please. It happens because of a technology called blockchain. At its absolute core, and you are all commerce students, so I'm sure you all are familiar with the idea of double entry bookkeeping. Blockchain adds a third entry point for you to keep track of your transactions. So imagine for a moment that you are all sitting in a classroom with me. I'm standing at the top of the table, and each of you has a notebook that you have to maintain your transactions in, debit and credit, very simple. I will say, okay, Vikrant owes Commercium 500 rupees, and ask each of you to note it down. Great, awesome. Maybe later on we say Commercium owes Vikrant 200 rupees for services rendered, and so on and so forth. And we decide to make this universal record of every transaction that has ever taken place. Now, if at a later date Vikrant were to say, you know what, no, Vikrant never owed Commercium 500 rupees, each of you would have your own individual record book to say, no, Vikrant, it's here, and all of us are saying it. Therefore, by sheer majority, either you're mistaken or you're a malicious actor. And this idea of having this universal checks and balances system be employed by technology is at its very core how a blockchain works. Now you take this universal classroom and you expand it out to the world. You take this notebook that we're talking about and you make it a computer, a very highly powered, specialized computer, and you get what is now known as the Bitcoin network. So now how are these transactions processed? I will, let's say, owe Commercium a certain amount of money. This transaction will be uploaded into my books of accounts. It will be uploaded into Commercium's books of accounts. And then as a third checking point, it will be uploaded to this universal ledger called the blockchain. Therefore, now each of us have our own debit and credit, but this third triple entry bookkeeping system also made sure that you have that final external check as well. This is fully transparent, it is fully secure, and generally cannot be tampered with, simply because, to come back to the idea of, let's say, Vikrant tried to pull a fast one and say, no, Commercium never owed me money. Only in the case of, let's say, Vikrant deciding that he had brought more than 50% of the students in that classroom to his side to say, okay, no, you guys will say with me that no, Vikrant never owed money. only in that case will this sort of scam actually work. Now, it's very easy to try and convince, let's say, 26 out of 50 students in a classroom. But make that a few million people, make that a few million computers, and it's certainly possible, but mathematically highly improbable. Building on the idea further, why? So we've talked about now how blockchain is transparent. Why is blockchain secure? It happens through a process called blockchain mining, or the proof of stake or the proof of work protocol. Essentially, what this means is that you have these computers that make up the blockchain need to compute a very complex math problem before the transaction is verified and added to the blockchain. Simple analogy. Imagine you are a pizza delivery service. All right. Pizza Hut, very standard. You have a restaurant. You receive one order and you need to ensure that the order reaches the restaurant, reaches the address that has placed the order. There's one way to do this. You can make 20 versions of the same pizza, give it to each of your delivery riders, and have them all go to that address. Highly inefficient, highly not the most sort of best use of your resources, but you will make sure that at least one pizza reaches. That one pizza that reaches, you will pay that delivery driver the amount of salary that they're owed for that one delivery. This understanding is called proof of work, where you have different computers on the network compete with each other to ensure that every transaction is processed. Now, of course, I'm sure you can see that there are very many inefficiencies with the system like this, which is also why you will find so many conversations around how Bitcoin is not, or how blockchain is not energy efficient. Here's the thing. Everyone knows about this and there are fixes in place. So where the idea of proof of stake comes into place, where instead of having 20 delivery drivers take the same pizza order to one delivery restaurant, to one address, you will bring, much like a regular standard restaurant, every single driver gets their own different address and is told, make the order and you get paid. All of a sudden, you're seeing that much more efficient use of your resources, which is what proof of stake does. And it is sort of the second iteration to how blockchain processes transactions. So we've understood on a surface level how blockchain works. Awesome. Great job. High five. What does crypto have to do with it? Think of blockchain as the architecture. Blockchain is the infrastructure. Blockchain is the train tracks on which a train runs. The train tracks can be set whichever way you want them to. They can go from Bandra to Jogeshwari. They can go from Andheri to town. Every different train can choose to figure out its own destination, but they still use the same fundamental infrastructure of the train tracks. That's how cryptocurrency and different blockchain projects work on the blockchain. So let's go on to the next slide about what crypto is. Let's talk about Bitcoin first and foremost, because that is the primary crypto out there. Bitcoin was set up by an anonymous person or group of people called Satoshi Nakamoto as a way to establish a global standard of moving money. Now, think about the number of hoops you have to jump through every time you travel abroad, or every time you need to send money from one place to another. Very simple UPI transaction needs a phone number. It needs a bank account to be linked to. It needs the phone number to be verified by your bank. You will then need the third parties, the person to whom you want to send money. You will need their address. And then you're going to need to pay them a fee and pay your banking partner a fee for making this transaction go through. This process becomes that much more troublesome if you want to send money across borders, because then there's the idea of, conversion rates or remittance rates, and all of that comes into play as well. With Bitcoin, the idea Satoshi wanted to bring about was twofold. Number one, one world, one currency, Bitcoin. And the second was you simplify this process and make this currency inflation proof. So now coming back to the idea of one central party that determines the value of money being now decentralized, and the value is now derived by the demand and supply of people who use that money on a day-to-day basis, you're beginning to see now the value that Bitcoin offers. To add to this further, there is nothing technically stopping a government or a governmental body from just printing more money and devaluing the rupee. In fact, I'm sure you've heard of the case of Germany after World War II, where people were taking wheelbarrows of the German mark to buy a loaf of bread. With Bitcoin, there are only ever going to be 21 million Bitcoin in existence. What that limited supply does implies that then the value of Bitcoin is deflationary, because as time progresses, every individual Bitcoin becomes that much more valuable. And because Bitcoin is infinitely divisible, you don't need to buy one Bitcoin. You can buy half, you can buy 10%, you can buy 0.0001% of a Bitcoin. Suddenly you have future-proofed the value of your money and made sure that you're never going to face a situation where the price of something relative to Bitcoin has spiked completely unnecessarily. So this is one application of crypto, which is one application of blockchain. Both can be used for so much more. So let's think about a little bit of those applications. Blockchain on its own, the distributed ledger technology, can be used not just in finance, not just in fintech, but with insurance, with healthcare, with, I think my favorite example here is that the Prime Minister's debt relief fund, the one that is used for farmers' debt relief. There is an Indian startup called Chainlink that is planning to automate that entire process of estimating rainfall, estimating crop performance, and then planning out dispersal of funds to farmers, to have this be completely automated and completely transparent on the blockchain. More than that, it's not only just being planned. We're seeing this happen in real time, where another Indian blockchain startup called Matic, now it's been rebranded to the Polygon network, is being used to track the results of every RT-PCR test that Maharashtra has. How is that happening? Again, the very simple idea of having that third universal check of, okay, I have my RT-PCR test. The government, the agency that issued it has it as well. But now anyone who needs to sort of access my results can use that one unique identifying code and access it from the blockchain directly. Infinite number of applications for blockchain here. And I think that's why so many people have called it a solution without a problem. Because, and you'll find a lot of the crypto bros of the world, they'll try and put blockchain into any solution. But doesn't necessarily need to happen. And that value or that mileage may vary depending on how convinced you are by the vision. Speaking of how convinced you are by the vision, let's say that you see the immediate value of crypto. How do you get started investing? Can we go to the next slide? My very simple thesis is to follow the approach called dollar cost averaging. And we're going to sort of talk about that example, and we'll go to the next slide in a moment. But before we sort of enter that space, let's remember that gold has been around for at least 2000 years, well before humans started recording, humans started recording the passage of time. The floating exchange rate system, the one that we use to now establish, how many rupees $1 is worth. That's only been around since World War II, since post-World War II, in fact. So let's say 60 years. Bitcoin has been around since 2009. So do remember that a large function of the volatility that you see in Bitcoin or crypto valuations happens because we are seeing its infancy. We are in sort of, if you have the bell curve of a product life cycle, we're still in the early adopter phase. And I think it's a marker of just how game changing this could be to not just the financial system, but the world, that it's already making such an impact and it's only being used for very, very niche purposes as of right now. A lot of, I think the biggest reason people are afraid of investing in Bitcoin or investing in crypto is because of the volatility. It goes up 10% one day, it goes down 15% the next day, and that just happens. How do you protect yourself against that? How do you make sure that you can see the value, the long-term value of Bitcoin without sort of putting in money today and watching the value tank tomorrow? This is where dollar cost averaging comes in. Just a quick show of hands here, and you can use the reaction, and I don't know, let's use the thumbs up emoji. How many of you are familiar with how mutual fund SIPs work? Thumbs up emoji if you have, or if you've invested, great. Yeah, I can see 1, I can see 2, 3, 4, 5. So let's say about 10% of you, roughly. Dollar cost averaging, or in our case, rupee cost averaging, works the same way. You are, instead of putting one lump sum of money into crypto directly, you are hedging your bet against time. So how does that work out in terms of actual quantity? Samarth, can we go to the next slide, please? So here are two different strategies that we can look at. One is to invest all of your money into crypto, into Bitcoin in one go. And if sort of Bitcoin drops, or if the value of Bitcoin drops, let's say 10%, suddenly your $5,000 is only valued at $4,500. Not the greatest idea. Alternatively, you hedge your bet. You hedge your bet against time. And you say, you know what, I'm going to invest 500 rupees every month, 100 rupees every month. And this is the beauty of Bitcoin, right? Because it's infinitely divisible, you don't need to be putting 5,000 or 50,000 rupees every week, month, day, as often as you're comfortable investing. You can start with 100 rupees. If you're careful, you can start with even less. Invest regularly. Make a habit of it. And in fact, with Zebpay, we have a service that does just that for you. And what ends up happening is that you follow the market up as the price goes up, and you follow the market down, and you've built essentially checkpoints at every stage of the game. How does that end up looking like? Can we go to the next slide? That's what can happen. So Arun bought, one slide back, Samarth, please. Yeah. Arun bought all of his Bitcoin on the 1st of Jan 2018 and ended up with 30% of a Bitcoin. Beena has spent her time. She said, you know what, I can afford to wait, and has ended up with 2x of that Bitcoin. And this is keeping in mind the fact that the value of Bitcoin has gone up, it's gone down, it's done its whole dance up and down. Why does that happen? Because if you think about it, think of Bitcoin like a restaurant. When a restaurant has just begun, you will have, let's say, 10 people eating, 10 covers filled up. If one leaves, that's, oh my God, suddenly that's a 10% drop. Think of now a restaurant that's more established. It's been around for 2 or 3 years. There have been very happy customers, happy reviews, all of that's happening. Suddenly you have 100 customers every night. Then if one person leaves, that's a 1% drop. That idea scaled upwards of in magnitude is how the volatility of Bitcoin starts to make sense. It's still a very young tech. Let's keep going. So can we go forward one slide? So now we've established that, okay, we have a way to get used to the basics of Bitcoin, right? How do I become confident in even that much? How do I make sure that, you know what, I'm putting money down into a solid investment? Because Bitcoin's great, Ethereum's great, but there are hundreds of new blockchain projects that are inaugurated every day. And each of them will sound amazing because they all have really, really smart marketing teams behind them. How do you establish, what is a solid project versus what a scam can be? because unfortunately our industry is full of people who are more than willing to just take your money and run away with it. How do you safeguard yourself against not just the volatility of a project, but also malicious actors? So very, very unsubtle plug here. With Zebpay, what we do is we offer a very curated list of coins so that no matter what you end up finally choosing to put your money into, you will be assured of a long-term return. But let's say you want to be brand agnostic. Let's say, you know what, Vikrant, I respect what you're doing, but I'm going to make my own decisions here. How do you establish what kind of blockchain project, what kind of crypto is the one that you want to put your money into? In my experience investing, I try to understand it by answering 4 different categories of questions. So Samas, can we go to the next slide and look at those categories? Let's look at these top to bottom, left to right. The first question you want to ask is about the project itself. Much like you would evaluate, in fact, this is very similar to how venture capitalists evaluate which startups to fund. You want to understand what the project is doing. What is the value proposition of the actual token you want to be buying? What problem are they trying to solve? So with Bitcoin, global standard of money, infinitely divisible, infinitely portable. And essentially you don't need to sort of, if you wanted to buy Bitcoin versus gold, the portion of your gold return will always go away because of storage costs. Bitcoin, just keep it on your phone. Awesome. Good job. We figured out Bitcoin's project value. About the developers, who are the people working on the project? What makes them the right people to solve the problem, right? If I were to say, you know what, I'm going to build a ship, I'm going to start a company that's going to get humanity on the moon as a commercial venture in the next 6 years. Are you likely to put money into what I'm offering? No, right? I mean, who am I? What basis do I have to make that claim? Versus Elon Musk has already done it once. He has that track record established. Essentially follow that same understanding for the crypto projects that you want to be putting into. So let's take an example of one of my favorite tokens called BAT, or the Basic Attention Token. What they do, what their core value proposition is, it's called a browser called the Brave browser. Picture Google Chrome. Picture Google Chrome, add in the most beefed up ad blocker you will find and have it be part of the basic package. So essentially you will have an ad-free browsing experience with no trackers or tracers trying to figure out what your search history has been. And then offer your users the opportunity to view ads if you would like to. So you can view 0 ads if you want. You can view up to, let's say, 5 ads an hour. What does that have? What happens then? For me as a user, as the end user, I get to choose. I have a little more agency in deciding how many ads I want to see. Vikrant, as a marketer, on the other hand, gets that many more valuable leads because I know that the people who are clicking on my ads now are not the people who have, let's say, accidentally clicked, or, I don't have to be shady about it. These are the people who are voluntarily looking at what I have to offer. Then over and above that, if you say, I'm going to compensate you for your attention, I'm going to give you a certain amount of BAT for looking at my ads every month, and you're beginning to see the value in it. So this all sounds great, but who is the person to be building a project like this? In Brave's case, in BAT's case, just the developer of JavaScript. Again, let me do a quick poll of reactions. Who all here is familiar with what JavaScript is? If you can put your thumbs up icon again, that would be great. You can see 1, 2, 3. Okay, so not too many people. JavaScript is the reason the internet looks the way it does today. JavaScript essentially is one of the core functions of Web 3.0. It allows you to embed your videos into websites. It allows you to sort of have pop-ups be that much more seamless. Absolutely core part of our browsing history, browsing experience today, even if we don't know it. The developer of JavaScript, Brendan Eich, is the man who's sort of working on the Brave project. Meaning that if you have someone at that level who's willing to stake his reputation on a project that he's working on, it becomes that much more valuable in my eyes. So, okay, we've established about the project, we've established about the development. What about the community? Much like a restaurant, you want to know what people are saying about the project, right? What is the community sentiment like? If I were to go to, let's say, the BAT subreddit or the BAT's account on Twitter and see that people were constantly cribbing about how they've lost money, or how the development team is never pushing any updates out, or there's no transparency in how the company operates, that's going to set off red flags. That should set off red flags. Versus if I were to go to their Twitter account and see just how people saw value in the long-term project, how people were confident in what they were investing in, that's a green flag. That's a good sign. Over and above that, if a project does not have a social media presence, or if their social media presence is fishy, that's a massive red flag. And also, here's the thing, you need to go beyond just looking at, let's say, a follower count. I have stories here where you learn just how easy it is to buy followers, to just show, oh, I have 10,000 followers on Twitter, I'm a baller, and people fall for it. Look beyond that. Look at, let's say, how much engagement those accounts are getting. Who are they talking to? What are the people who are sharing and engaging in those content? What do they look like? If you're feeling particularly brave, reach out to those people. And then the fourth category of questions that you really like for bonus points is to understand the trading activity. Understand why people are buying a particular token. With Bitcoin, it may have been built initially as a system of global payment. Now it's being used almost like digital gold. People are buying Bitcoin, holding on to it, knowing that as more and more people begin to adopt Bitcoin, the demand is going to go up. Infinite demand or highly growing demand, but a limited supply means that the price is going to skyrocket, and it has. Versus, let's say, BAT. BAT has a very liquid trading activity because people get a fresh supply of BAT every month. Are people holding on to it? Are people trading it up and down? What's the thought process behind why it's being traded that way? Understand that underlying principle. Understand what is called an investment thesis. Fancy word. All it means is why are people buying a project? And investment theses. And in fact, here's the really interesting aspect. In my experience, everything you've learned with traditional finance, technical analysis, fundamental analysis, all apply to blockchain and crypto projects just as much. All that happens is that the shift that will happen in, let's say, a year with the traditional finance, with the stock market, happens maybe in a month in crypto, if not less. So I'm going to sort of take a pause here because I've spoken for quite a bit. I'm going to get myself a quick glass of water. I want to understand what questions you have for me now, and we'll sort of try and make this as interactive as possible. All right. Samarth, we can stop the screen share. I think that's all the slides I had. All right. I believe the moderator was looking over the questions on the link.
Yes, hi. One of the questions that we have here are, should investment in cryptocurrency be a long-term or a short-term one?
Great question, and points to whoever asked it, because I think you've got to the absolute chase here. Depends on your appetite for risk, very obviously. So think about it this way. If you are willing to put in the time and effort to research into what opportunities there are, and then put in a significant amount of capital to take advantage of that risk, it can be a short-term gain. To me personally, as an investor in Bitcoin, I think there is a significant amount of scope for the long-term potential that will vastly outstrip anything that a quick a quick short-term trade will ever make. Why am I bullish on Bitcoin in the long term? Is because, very simply in one word, Wall Street. In the last year, starting December 2020, we've started to see a whole bunch of very well-known traditional finance and investment houses start putting Bitcoin on their balance sheets. The two knock-on effects are, number one, again, higher demand, higher price, meaning that everyone who holds Bitcoin is suddenly dancing. Beyond that, the larger sort of knock-on effect is that if Vikrant is saying, buy Bitcoin, it's amazing, it has a limited amount of mileage, even if I say so myself. If Lehman Brothers is saying it's got Bitcoin on its balance sheet, suddenly a lot more people are paying attention. And as much as Wall Street likes to talk about how they are pioneers in the finance space, a lot of them ape each other very, very quickly when it comes to investments like these. MicroStrategy was the first that started with, I think, a $12 million investment in Bitcoin. Each and every one of them followed suit, whether or not they talked about it publicly. So short answer, long term, absolutely.
Okay, the next question is, what factors influence the price of cryptocurrencies?
So I think at its absolute core, it comes down to demand and supply. So let's talk about how very traditional fiat currencies is determined right now. It is a function of the amount of supply of money in the economy relative to, let's say, the amount of a currency that is in the US, the number of dollars to the number of rupees. Very similarly, the value of Bitcoin to the value of people who want to buy it relative to the amount of rupees in the market will establish its value. So we've seen, I think, Bitcoin go from 9 lakhs for one Bitcoin to about 23 in the last year, 23 lakhs to one Bitcoin. And why is this happening? Because so many more people have started investing. Demand has gone up. Demand is going up for, again, a limited supply of Bitcoin.
Okay, great. Is it really worth it to buy cryptocurrencies as the initial boom has already happened?
I'm sorry, Ikshita, I lost you there. Could you repeat the question, please?
Okay, sorry. The question is that is it really worth it to buy cryptocurrencies since the initial boom has already happened?
Oh, yes. So two reasons here. One is, are you going to become like a Bitcoin billionaire overnight? Like, are you going to be one of those people who bought it for like 100 cents and now is worth multi-millions? Probably not. Is there still scope for a massive amount of value gain? Absolutely. And real life example, right? I started investing in Bitcoin more strategically, like with a plan, in May of 2020. My most recent investment is showing, I think, a 300% return. And again, with all due respect, this is again following the rupee cost averaging approach. Fixed amount every month from my salary. I started with 5,000 rupees a month.
Okay, so the next question is, how will a decentralized, unregulated economic system work in centralized in a centralized regulated political system?
I love
Since
it.
all central banks are going to launch a nationalized crypto?
Yeah. So great question. I think this is also one of those that cuts to the chase immediately. Let's look at this in two ways. What who asked the question, if I may ask? Like, does that track it? Okay, no worries.
I think they're anonymous. Yeah.
Okay, no worries. So let's approach this in two ways. One is, how do I explain this basically? how does a decentralized currency or a decentralized financial system work in a centralized economy? There's two schools of thought to how in the crypto community as to how this should happen. One is the ultimate crypto, I'm going to call them crypto purists, which want crypto to be its own separate thing until what is called the flippening, where people just immediately see that there is more value in crypto and switch like overnight. Very idealistic in my opinion, and I don't necessarily see it happening. A much larger section of the crypto community is what I'm going to call looking at a graduated approach. So how does that work? It starts with crypto getting legal status. Crypto in India right now exists in what is called a legislative vacuum. It's not illegal, but it's not strictly legal either. There is no law that strictly says Bitcoin is okay to buy. We need to start by establishing that it is legal, because that will then establish that it'll sort of become a much easier way to bring widespread adoption. That's stage one. Then we bring in value with Matic, with the Polygon network, RT-PCR, and all of those. With Chainlink, it comes down to bringing value to the farmer debt relief fund. Iteratively, you start sort of adding value to existing centralized systems. And over the course of years, I'm not saying this is going to happen overnight. I think, to me, and I'm not the greatest at estimating these things, it's going to be a 15 to 20 year cycle where you see the value that decentralized systems bring, and iteratively they will sort of phase out the existing system, the legacy systems that we have in place. If they don't completely phase them out, they will, they will add on to that and sort of be a retrofitting process. Yeah. I hope that answers your question. That's an A1 question. I think it's one a lot of people have, and it's one that a lot of people in the crypto community are very cagey about answering.
I think that should have answered it. The next question that we have is, how do we make our own cryptocurrency?
How do you make your own cryptocurrency, like from scratch? Okay, so great question. If you ask me to like code a blockchain, I have no clue. However, what I can do is point you in the right direction of people, and I can give you the broad strokes of what needs to happen. There's two ways you can go about it. One is you can build your own blockchain in Flutter from scratch, and that's one way to do it. Alternatively, you can piggyback off of the Ethereum network and use one of the Ethereum protocols, ERC20, ERC721, all of those, to build your own cryptocurrency token. How does Ethereum work? And I'm hoping the video game analogy that I made with all of you yesterday on Friday works this time. If any different cryptocurrency project is a video game, let's say you buy a racing game or an action game or an adventure game or a platformer or whatever, Ethereum is the Unreal game engine that acts as an infrastructure, that acts as a toolkit to help people build games, different kinds of games faster, different kinds of blockchain projects faster. Another project called the Cosmos ecosystem works very similarly. So you can look up essentially what is the end goal of your blockchain project, what is the end goal of your cryptocurrency, and then find the equivalent Ethereum protocol and code it accordingly. It's not as difficult as it sounds. However, you do need a fairly sufficient understanding of coding fundamentals.
Okay, the next question is, how much minimum percentage of our portfolio should be in cryptocurrency?
Okay, that's a good question. And unfortunately, it's not a question I can strictly answer, simply because it's not exactly my place to be giving you direct financial advice. However, what I will tell you is, number one, dollar cost average, rupee cost average, best thing in the world. Number two is only invest the amount of money you are willing to lose. Okay. It's not the greatest answer, and I apologize for not being able to give you a more comprehensive response. But the fact of the matter remains that with crypto, your own mileage will vary. It depends on your own risk appetite. Are you willing to sort of watch the value of your portfolio sort of go haywire over a couple of months? If you're comfortable with that idea, by all means. If it's not something you're super comfortable with, and in my case, for example, you may want to pair that, or sort of, how do I put it? Pair that up with very conservative investments in traditional finance. So, so that you're at least assured of a particular safe return.
So that's it for like the questions that have been asked before, but we will be opening up this session for people if they want to unmute and ask anything.
Absolutely.
So if anyone would like to, they can do so right now.
So what I'd recommend doing is just do like the raise hand, and it'll help the team identify who's who.
Hi. Yes, I think any of the participants, they can raise their hands and they'll be unmuted by one of our team members, and they can just ask their questions indirectly, and Mr. Vikrant can then answer it.
Just Vikrant is fine. Just
Hello.
put that up there. Yes. Hi.
Do you have a valid criticism of crypto?
Yes, I do.
Something you don't like?
Absolutely. I think my
One
top,
more thing. Do you have some skin in the game? Like if we invest in it, you would profit with it in some way. You are invested in this idea, right? You
Okay.
have some skin in the game.
Yeah.
So try to criticize this from a neutral perspective.
Absolutely. So I think in order of priority, my biggest criticism is that crypto is not as decentralized as it should be. And if you look at, I'll send the link in a post. I'll see if I can find it right now. But you can find the percentage of Bitcoin that is held by the top, let's say, 1% of accounts versus the bottom 80% of accounts. I want to say upwards of 87% of all Bitcoin in supply today are held by the top 2% of all Bitcoin wallets. As much as we want to talk about how Bitcoin is decentralized, how we want to talk about how it's this amazing panacea for everything, this is, in my opinion, crypto's dirty secret, that it's not yet as decentralized as it should be. The idea of sort of the income inequality of distribution, inequality in distribution of wealth continues today. Are people trying to fix it? Absolutely. Is it going to be a process? Yes. Beyond that, I think crypto right now is in its very bro phase, for want of a better word. Very, very male dominated. I mean, you could say that that's true for tech, but as a function of, like, if you take tech as the umbrella term, if you take fintech as the category under that, and you take crypto as under that as well, ridiculous. It's a boys club. And that's not something I'm super happy with, because then if you have actors like, let's say, an Elon Musk unilaterally decide that they're going to not accept Bitcoin at Tesla, you're going to then mess with the holdings and investings of a whole population of people. And that's something that needs to be fixed. So there is a whole level of maturity that the blockchain industry needs to reach. Does that act as an adequate criticism?
What about the technology itself? You talked about the gender representation and the economic inequality, but what about the technology itself? The Bitcoin and the blockchain system can be replaced by something in the next decade or two. It does not have some intrinsic value like gold has. Like I can sell gold to somebody. I can't go on the road and sell crypto to somebody. Also, I do not need to maintain gold. I do not need to invest in the maintenance of gold. But for crypto, I need mining centers, I need data centers, I need internet packages, I need connections, I need so many things. But gold itself, just go and sell it to somebody. It does not have any intrinsic value. It works like a cult.
Okay, fair. Works like a cult, more accurate than I'd like it to be. Does it not need any particular investment? I think that's where there is a slightly factually incorrect sort of statement there. You can buy Bitcoin on a trade exchange like you would buy a stock. You don't necessarily need to have a full mining setup. More than that, I think on the gold side of things, you do need to maintain gold because you're going to be paying storage costs at every stage of the game, even if you try and move it. But coming to the intrinsic value of Bitcoin comes from the limited supply, comes from the idea that it is a deflationary currency. And finally, my criticism of the technology comes from the fact that it's, how do I put it? Its transaction speed, the efficiency of the system itself, still very, very slow. I think if I remember correctly, and I'm going to be estimating the numbers here, the Bitcoin network can manage about 14 transactions per second. I'm just going to Google this because I want to be accurate here. Bitcoin can have, oh, I'm sorry, not 20. Bitcoin can average about 2,500 transactions every block, 4.6 per second. PayPal, for example, on a very similar metric, averages about 200 transactions per second. So it needs to hit that level of maturity. It needs to sort of, the tech itself needs to advance to that point where it will then see an actual sort of long-term value. It's not there yet, but it's going to also need time. Let's not forget that it's barely 12 years old.
Right. Thanks a lot, Vikrant, for your answer. I think we can move on to the next question. Since there are a lot of questions, a lot of people have raised their hands. Anyone who can unmute
Yeah.
and ask.
Yeah, thank you so much. This is Saurabh here. Thank you, Vikrant, for this session. It's been really insightful. So my question is basically, what are your views on NEPA POWs, which is basically the non-interactive proofs of proof of work, which is a popular feature of Cardano and the token ADA. So it basically is allows interoperability within platforms and blockchains and blockchain techs, basically. So what do you think about that?
So Cardano is actually one of the tokens that I want to be doing a lot more research on. Unfortunately, I don't have a lot of it in hand at the moment. Happy to follow up with you on this in an email later, but I don't want to give you an uninformed answer.
Yeah, that works. I'll email you then.
Absolutely. And
Thank you.
I will ask the team to sort of share my email with you. Or
Sure.
LinkedIn works as well. I'll put my LinkedIn in the chat.
Sure. Thank you.
Hello. Am I audible?
Yes, you are, but
Yeah,
I'm not sure who's speaking.
Robin here. Hi,
Okay.
Vikrant.
Hi, Robin. Tell me.
Yeah, regarding the dollar cost averaging bit you mentioned. So like if the investment you identify turns out to be like a really bad pick, you don't only be investing steadily into a losing investment, right? So here, won't there be a serious assumption that Bitcoin values will definitely go up in the long run? Like unlike other asset classes like equity, which are tied with the economy and they're expected to rise in the long run, like ignoring the short-term fluctuations. That's the reason why you invest in an SIP. So you end up buying more with this amount when the value goes down, right? So there is a serious assumption here, right? That the Bitcoin values will definitely go up in the future.
So here's the thing, right? The value of Bitcoin is also tied to the economy, just as much as any standard traditional form of finance is. More than that, I think the dollar cost averaging approach is, my opinion, starts with the two very basic, like what I'm going to call the blue chip cryptocurrencies, Bitcoin, Ethereum. Those are, I think, the most valued or the most widely accepted. Over and above that, if you want to then sort of start diversifying your crypto investment specifically, you start looking into that 4-step approach that I was later built on, where you look into the particular fundamental analysis of what every project is offering. And that is research that hopefully you are doing before investing into equity as well.
Yeah, got it. Thank you.
My pleasure.
Hello. Yeah, Aditya this side.
Hi, Aditya. Tell me.
What is the term mean mining? Means who are those people who solve those maths problems? Yeah.
Okay. So a Bitcoin miner is essentially a person who is verifying the transactions that are going onto the blockchain. How does this happen? For every transaction that is sort of processed or needs to be processed, you have a certain unique tag that is added to the transaction, almost a UID. This UID is generated using a very unnecessarily, in my opinion, complicated algorithm that cannot be reverse engineered. So to take a very simple example, if I were to sort of say the UID of my transaction with Commercium is 4, we don't know whether the component sort of UIDs of that transaction were 1 plus 1, or sorry, 1 plus 3. Was it minus 5 and plus 9? Was it 2 and 2? Scale that idea up, and you have this complicated maths problem that every blockchain miner competes to complete, and then have the chance to verify transactions, add it to the blockchain, and as a function of this, earn a percentage of Bitcoin for every transaction that it verifies. So I think the person's username was failsafe. This is where you need to be investing in your specialized tech, investing in electricity, because as it stands right now, and it also sort of ties into the idea of inequality in wealth generation, Bitcoin's proof of work is highly competition driven. Only the first person to verify that, or only the first person to complete that transaction, that mathematical problem, gets to earn Bitcoin off of it, gets to gain the mining reward. So this has led to a whole bunch of knock-on effects, wherein you're seeing multiple people buy out whole GPUs because they want to be mining Bitcoin with it. It was a market opportunity for both ASIS and every other GPU manufacturer in the market, where they now manufacture what are specialized Bitcoin mining processors called ASICs. And not everyone has the capital to gain access to these things. So naturally, you're going to see the people who have a significantly larger capital base to start with are also likely to have a larger capital base in Bitcoin. This is where I'm talking about how Bitcoin is not as decentralized as I would like it to be, because it's not fixing the fundamental problem of wealth inequality, not yet. And I think personally, it needs a policy fix as opposed to a tech fix in this case. But coming back to the very basic idea of mining, verifying transactions, completing a complicated mathematical problem, gaining a particular amount of Bitcoin as a reward, and that particular Bitcoin reward acts as your incentive to keep sort of investing in this cost. Does that answer your question?
Yeah, sir. And so what skill we need to become a miner?
You don't need skill as such. You need money more than anything else. But at its very basic, you need to be comfortable with working through laptop and OS BIOS. You need to be comfortable with, I forget what code it is, what language it's programmed in, but I'm going to call it, you need to be familiar with code. And more than above that, I think you need to be confident in how you sort of set up your how you set up your mining node or your mining processor to work with the blockchain, and also then have the know-how to know which blockchain network you want to be a part of. Bitcoin right now is not the most profitable. However, if you want to look into, let's say, working with the Polygon network or working with the Atom network, then the profit motive starts to make a little bit more sense. Alternatively, and right now this is ridiculously expensive, you could set up what is called an Ethereum staking validator. Works the same as a blockchain, as a mining node, but because because the chance to sort of verify these transactions is randomly generated, you have a larger percentage or a larger chance of making revenue off of it. However, the capital base you need to set up one of those, ridiculously high. I think if I remember correctly, it was at 32 ETH when ETH2 launched. 1 ETH right now is about 2 lakhs. So it'll be about 64 lakhs.
Okay. Thank
you. Due to time restrictions, we'll be taking one more question from Pratham, and then we'll be moving on to closing.
And I mean, if you have any more follow-on questions, please do reach out to me on LinkedIn. I spend more time on it than I should be. And if I can't answer the question, then I will be happy to introduce you to the people who can.
Hi Vikrant, Pratham here.
Hi Pratham.
So the question that I have is that, a bunch of crypto investors and particularly Bitcoin investors make decisions based purely on speculation and are lucky enough to find those positive returns. And there's a term coined, they call it the greater fool. And investors like Michael Burry have pointed out that we might be entering into a bubble of unprecedented scale. So what is your view on a potential cryptocurrency bubble with respect to how stocks are being tokenized these days, specifically stocks like Tesla, and how exchanges like FTX are bringing these aspects into picture? So I just want to understand your view on a potential cryptocurrency bubble.
Great question. And I think this is something that I'm going to have to think about and do a little bit more homework. But on the surface of it, my immediate knee-jerk response would be that I think the likelihood of seeing a cryptocurrency bubble in 2021 onwards is significantly less likely than it used to be, let's say, in 2016 or 17. The reason I say that is because if you look back at the two natures of the bull runs, one in 2020, one in 2017, and look at the fundamental reasons behind them, very, very different causes for these effects. In 2017, and I believe this is around when Michael Burry made that statement, it was driven entirely by speculative investors, much like what we saw happen with Dogecoin in the last few months. Everybody bought for the sake of buying and for the sake of sort of in the hope that it would, the price would reach a particular point. In Dogecoin's case, we saw that entire sort of multi-year cycle of Bitcoin happen in a few months. And we immediately saw the crash happen as Elon Musk appeared on SNL. Comes back to why I think the Bitcoin is not decentralized enough. We watched that price fall immediately because everybody sold. That's also why we saw the Bitcoin crash in 2017, because it hit a point where one whale decided he'd made enough money, sold, and it led to the knock-on effect of suddenly the price is dropping, people are panicking, more people are sort of selling off in a hurry. Cut to 2020, you have people investing for the long-term fundamental value of Bitcoin. And over and above that, it's not individual retail investors. It is full-time, what's it called? Fund houses is not the right word. It's essentially Wall Street that is making these investments. And they are making these investments at a significantly larger scale than either you or I could as a retail investor. Their skin in the game and their incentive to hedge funds, thank you. Their skin in the game and their incentive to keep the price of Bitcoin either at a particular level or continuously growing and therefore their ability to make sure that that level continues to be maintained much stronger than, again, a retail investor. However, the problem or the potential downside here is that we are going to enter a phase of very large market makers. If, let's say, and we saw this happen, or this is sort of the conspiracy theory that's being floated on Twitter, I think it has more merit than most do, is that the most recent Bitcoin market correction that we saw that started in May was in fact started by one whale or two whale wallets. A whale wallet, just to give you context, is one that has a very large amount of Bitcoin holding it, sold out with the express intent of, yes, very similar. Sorry, Akanksha DM me on this one. With the express intent of sort of buying low, selling high, buying low. And if you can do that at scale, makes a massive difference. However, and this is why I personally think that Bitcoin needs to be legislated, because as of right now, if it continues to exist in this vacuum, it's not going to solve anyone's problem, because it's the Wild West. The moment you enter at least a very basic rules of engagement of how this needs to be traded, how this needs to be handled in a legislative sense, a lot of this immediately goes away. Because when you combine the factor of even the most basic legislation with how transparent blockchain can be, you have, if nothing else, you can then understand who is sort of manipulating the market, and then those people can accordingly be sort of dealt with the consequences.
Yeah, thank you so much.
My pleasure.
Right. I think we have just one more question. Vikrant, if it's fine, can we take just one last question?
Absolutely.
So I think Saurav, you can go ahead and ask a question. It would be great if you could keep it brief and short, considering the time restrictions.
Yeah, I couldn't unmute because I don't know, the moderator stuff. Anyway, so in a proof of stake system, essentially doesn't the rich get richer and richer? As in, when, let's say, a person has a higher holding of, let's say, a coin, let's say it's Cardano or whatever proof of stake system based token is there, so they have a higher probability to get voted to validate a block, right? So that can be said true for a proof of work system also. Essentially, along the lines of, if you have more machine power, you get to validate. You have a higher chance of probability to get to validate a block, right?
Yes.
But they have a higher incentive not to just get more money and buy more tokens, because they have to invest in those machine power inherently. So that's the distinction between a proof of stake system and a proof of work system, and why proof of stake system is more crony capitalist in that sense. What do you think about that?
Interesting take. But, and I see where you're coming from. The only difference that I'm going to sort of draw up here, and honestly, I'm going to have to think about this again a little bit more, is that with crony capitalism, essentially the stakes are not immediately evened out, right? The moment you have a significantly larger capital base, you can sort of rig the rules of the game as such, whichever way you want to push, like whether it's through lobbyists, whether it's through any other of the levers that you can pull. With staking, it is, you are accurate in as much as someone who has more capital can gain larger validators and then have a relatively higher probability of validating tokens. There are safeguards already in place to sort of ensure against that. And second of all, even if they do, it's going to again need a much larger capital investment than it would with a proof of work setup. Simply because, number one, you have that many more people entering the market. And therefore, for this increased probability to make a difference, you would need to put in much more money. Because let's say like a 0.1% versus 0.2% is not going to make too much of a meaningful difference. considering that there are that many other actors in the game. However, I do want to come back to this question. This is something worth thinking about.
Yep. I think we'll have to talk further.
Absolutely. I'd love to.
Yep. Thank you.
I think with this, we have come to the end of this extremely insightful session. Thanks a lot, Vikrant. Over to Swada for delivering the final vote of thanks.
Before we end the event, I request all of you to please turn on your cameras for a quick group photo. Is the photo done, Robin? Yes. Okay.
Awesome. Thank you.
Cool. So with this, we come to the end of this wonderful. Am I audible? Hello.
Yes, you are. Yeah. You are.
Okay. So with this, we come to the end of this wonderful session. It was indeed an interesting and enriching experience. We would like to extend our gratitude to our esteemed speaker, Mr. Vikrant Mehra, for his insights, for guiding us throughout the session, and for making it a highly engaging one. Thank you so much, sir, for your time and efforts. Thanks to Team Commercium, without whom this session wouldn't have been possible. Last but not the least, we would like to thank our participants for being such an encouraging and supportive audience. We hope all of you enjoyed. Before we leave the meeting, we would like you all to please fill the feedback form which is sent in the chat box. It will help us to plan many such enriching sessions for you all. Thank you again for joining us today. We look forward to seeing you again in our upcoming events.
I think all the participants can take a leave now. Thanks a lot.